Is FD safe? If safe, how much? And if not, what is the alternative option? And how we can make use of this financial education to diversify your portfolio, and how you can make your FDs into alternative investment option for your retirement plan. Hello everyone, I'm Dr. Maria. I'm a chartered wealth manager and financial coach. I'm a AMP and IRDA certified financial advisor as well. Now, today in this video, we will discuss about EFD. In my previous video, I have discussed about is it EFD is safe or not. You can go and watch that video either in English or in other languages, Kannada and Konkani. Now, today we will discuss what is the alternative option for EFDs, because as you know, EFD is having only 5 lakh guarantee from the government. Now, you may ask this question, how many banks can go bankrupt? Because many people ask me this question. Yes, there are a lot of people who are investing in cooperative banks for higher rate of return. There are many cases which is still pending in court where a lot of people, retired people, have invested their lot of money, huge funds for highest return, and they are still finding difficulty to get their fund because their case in court. Now, you may ask, is all government banks can also bankrupt? I don't know for that. But how banks are operating? Because banks are giving loans to others for higher interest rate. They are investing in government bonds as well. Now, when they get higher returns, they are transferring their returns to you a fixed amount of return. So that is why FD is always fixed for a duration. Now, if you have a lot of money, more than crore rupees in FD, and you are scared about investing, scared to invest in mutual fund and stocks or any other alternative options, then there is an option which is really safe and which is giving more benefit than your FDs. Now, what is that? That is called as a guaranteed return insurance plan. Nowadays, a lot of insurance companies are coming up with the guaranteed return insurance plan. And some companies are giving guaranteed returns immediately after a week of policy issuance. Some are giving in month, some are giving in year, some are giving after certain duration. That is called as a deferment period. Now, which one is best? It depends upon you, your risk appetite, and when you want money. Okay. Now, this video is only as an alternative for EFD. I know there are a lot of people who are already invested in mutual fund, in stocks, and you are aware about market risk and rewards. For you, definitely this is not an alternative option, because I know your money is not there in EFD. Now, there are a lot of people who are conservative investor. They are scared with these instruments. For them, this is an alternative option. Now, I'll give you a comparison like how these investment options differ and what are the advantages and what are the disadvantages. As I mentioned earlier, EFD is having only 5 lakh guarantee from the government for the investment what you have done. So second one, tax benefit. If you are a NRI and you have invested your money through your NRE account, then definitely you are not liable to pay the tax. But if you are Indian and you have invested your money through your Indian savings account, then definitely you are coming under tax liability. And definitely, I know that if your money is more than 1 crore, 2 crore rupees, you are definitely coming under 30% tax slab. Now, just imagine there are a lot of people who are ignoring about inflation and taxation. That is the reason they are not aware. They're thinking that maybe I'm getting 6%, 7% rate of return, but actually not. There is an inflation 7 to 8%. This is a general inflation, what we normally call, and there is a education inflation is 10 to 12%. Medical inflation is 14%. Travel insurance is 20%. So you have to aware about these things. Now we'll come back to the taxation part. You are coming under 30% tax slab. Then definitely from the return, whatever you are getting, you have to minus 30% tax on that. That is the actual return what you are getting. Now, we'll come back to the other differences. Okay. Now, in guaranteed return plan, if you are investing 5 lakh rupees every year in insurance company, and whatever the returns which you are getting, that is non-taxable. Under Section 80C, and whatever the death and maturity amount what you are getting or your nominee is getting, that is also non-taxable under 10-10D. Okay, now taxation part is clear. Now we'll come back to the continuity benefit. Now when you invest your money in FD, if there is a death of the person, okay, then definitely the FD is closing there itself, and whatever the return they are getting as an interest, the principal plus interest will go to the nominee and the FD will close. Now what will happen in guaranteed return plan? If you have taken, in some companies they are giving as a rider, some companies it is an inbuilt. Now policy continuation benefit. Suppose if you have selected policy continuation benefit, after 2 or 3 years if the person died, then you just imagine 11 times or 12 times, it depends upon company to company, or sometimes it is 10 times only, 10 to 12 times it may vary. Now that much of money, if suppose you have invested 5 lakh rupees, if it is 11 times, then 55 lakh rupees will go to the nominee. Okay, not only that, from there the insurance company will continue the policy. The nominee need not to pay the future premiums. That is an added advantage. Not only that, if you have taken a 45-year term for your insurance policy for a guaranteed return plan, maybe imagine after 5 years the person died, then next 40 years you already enjoyed that 5-year guaranteed return whatever you have received. Next 40 years nominee is going to get that additional same amount every year whatever you are getting for next 40 years. Whereas your investment is very low, but the returns are continuing. But in FD, this facility is not there. Next, we'll come back to the life cover. In FD, there is no life cover, but here you will have a level, you will have 10 to 12 times life cover as well. Now, liquidity. If at all, if you wanted to get money lump sum, then there is an option in FD where you can close your FD and you can say that I want to get back that money. Even the term is not matured, still bank is giving you that money by deducting maybe 0.5% to 1% as a penalty, and they will give back that money. But when it comes to insurance, there are two concepts applicable. One, surrender value. Second one is a paid up option. Now in surrender value, if you are going to surrender your policy, whatever the benefit you got so far, you will get that. Not only that, so in front of how many years you paid, in your policy copy, if you check, there is a surrender value. From October 1st, 2024 onwards, as per IRDA's instruction, all companies has increased surrender value as well. You can check that in your policy copy if you have taken, or if you are going to take it, you can check that as well. Now that surrender value you are going to get on that particular year. If suppose you are struggling to pay the future premium and you are not able to pay the future premium, then definitely there is an option called paid up option. Now in that paid up option, you can stop paying premium after 2 or 3 years based on your policy. You have to check that, and from there, like, you need not to pay the premium, but whatever the returns which you are getting, that you are getting as per proportionate way. Now next, when come back to the risk of insurance, like as I already mentioned, there is only guarantee for up to 5 lakh, but here IRDA is backed up with that, and they are taking charge of all the policy holders. Then important thing is reinvestment risk. Now when you, after 5 years, your FD is matured and you wanted to, maybe you are getting a 7% return at present and you wanted to reinvest that money, then definitely there is an option, like you may not get 7% again. After 5 years, what is the rate it is applicable, that you may get. If you see a history from 1990, it has started with 16%, 14%, and reduce, and it has came up to 7%. One or twice, it has just increased 0.5% extra. But is it the same case in future as well? We don't know. But definitely there is a chances of decreasing your FD returns if you see a past trend. Okay. Now, but here the return, what you are getting, what they are fixing, if it is 35%, or every year, then that is fixed for next 40 or 45 year, whatever the term you have taken. So that is guaranteed, and guaranteed risk is there for a long period of time. And this is a retirement tool. One option for a retirement tool. Again, don't invest all of your money in only in this plan, because you have to check your corpus also, how much corpus you require and how to create that corpus also. As alternative for FD, of course, this is one option. And there is, of course, there is mutual fund, stocks, as I mentioned. There are a structured product where you can take advantage of that one. But it is one alternative for a EFD, which is far better than EFD. Now, who has to take it? If you are a businessman, if you are a working professional, and you are a very conservative investor, you are very scared about mutual fund or market risk oriented stock market and market risk oriented instruments, then of course this is the best option for you. For that, you have to be very careful that you have to do your financial planning, because financial planning is a tool which will give you a roadmap for your entire future. You know exactly how much money you require for each of your goal, whether you have emergency fund or not. Have you taken your term insurance? If you are not taken, please consider this is an important call and take it seriously, because your entire family is dependent upon you. Then you have to take term insurance. If you are not knowing about that, please watch my video where I have explained each and everything about term insurance. Next, you should have a health insurance, because that is a major chunk of money where people are losing out when they don't have a health insurance. Even though if you have a corporate insurance, please consider it is an important call you have to take. You should have a separate health insurance. You should have an emergency fund. You should have accidental insurance. Once you have these things, then only you can think about these investment options. Now we'll come back to the point, like even if you are running a business, you are a director of the company, maybe 2-3 of your family members are directors of the company, then you wanted to show more expenses and less profit, then you wanted to save tax, then definitely this is another tool where you can invest in this insurance plan and show as an employee expenses, because there is an option to show that, and you can take advantage of that one. So if you wanted to get more benefit out of that, and if you wanted to know more about that, you can directly contact us and we will help you to do that as well. Now we'll come back to the point how you can create wealth with this investment option by reinvesting. Very interesting story. Please take a note of it and do a calculation. If you wanted to understand more about through Excel sheet, you can book a one-to-one clarity call with us, and we will explain you how it works and how it really create a magic, and how you can make use of guaranteed return plus power of compounding. Okay, let me explain you through this one example. Imagine one person, Mr. Ramesh, who have 60 lakh rupees in FD, and he's a 35-year-old guy. Now imagine he's not so aggressive investor, he's a conservative investor. Now he wanted to just try this out. Now imagine out of 60 lakh rupees, he is investing 5 lakh rupees every year. And in 12 years, he is just removing his FD amount and transferring that to insurance amount. Every year, he is just moving 5 lakh rupees. The rest of the money is there where he is getting returns as well for FDs. Now, when you transfer 5 lakh rupees every year, if you are a 35-year person, you are ready to pay for next 12 years, and you have taken 45-year term. You are going to get 35% immediately after a week of the policy issuance. That means you can consider 1,76,000 rupees. Now, you just imagine you are dividing, you may not require that 1,76,000 rupees at present, because you may be earning, you have this money, and like you have an income. Now, instead of withdrawing that money and wasting, or like you spend for your expenses, rather you can create a magic through power of compounding by investing this small amount into mutual funds. Imagine 1,76,000 divided by 12, it will come approximately 14,667. You are doing a SIP of that every month. Now, 14,667 rupees for next 25 years till you retire. Imagine your retirement age is 60 and you are investing till that amount. till that year, and you are getting 24-year term, and you're investing approximately 14,667 exact amount, whatever you are getting. And definitely there is chances of getting 15% minimum. I'm talking about 15% rate of return, because even the market fall or going up 2-3 times in a 25 years, that is not a problem. Still you can get 15% rate of return. And with that 15%, your total investment for the next 25 years is 44 lakh rupees. And that 44 lakh rupees through SIP, it will create 4.81 crore rupees at the age of 60 years. Now imagine you are getting consistent income here, regular income every year, 1,76,000, even after you have stopped your premium after 12 years. And here you are getting a corpus of 4,81,000 rupees. Imagine today you are spending 50,000 rupees, and after the retirement with the 7% inflation, that 50,000 will become 2,71,000 rupees. Now, that 2,70,000 also every month you can withdraw from this corpus 4.81 crore. And along with that, for next 25 years, you are not, next 20 years, because it's a 45-year term, you are not investing any money, but still the guaranteed return will continue 1,76,000 rupees plus this corpus. I think it is magical. It is a power of compounding, and you can take a benefit of guaranteed return plus insurance coverage plus a reinvestment in magic of power of compounding. So this way you have to create a huge corpus for your retirement. This is one option which I have given. There are a lot of other options as well, and we will discuss more about power of compounding, mutual funds, SIP, SWP, all these things in our future videos. If you are not yet subscribed to my channel, please do subscribe and share this to maximum of your family members and friends and business people who kept their lot of money in FDs, because this is a best alternative option for FDs, where you can diversify your portfolio and create wealth and have a security and safety as well. And definitely this is not for those who have already invested in mutual fund, stocks, they know the power of compounding. This is not a best option for you, because you are doing good, do good there itself. But as an alternative, as a safety, you can consider this as well when you have huge amount of money, because retirement is a thing where you should have different types of investment. There should be a regular income, there should be a growth as well. Dear friends, so far we have discussed how guaranteed return is better than FD. Now we will discuss what is the advantages and disadvantages of guaranteed return plan. As I mentioned, one major important advantage for guaranteed return plan is taxation benefit, where whatever the amount which you are receiving, where you have invested up to 5 lakh rupees in one name, then definitely the amount which you are receiving is tax free. Now, when it comes to the other advantages, where guaranteed return gives you are sure that this is a return which I am going to get for a next period of next maybe 30-40 years of time, and it is consistent, where you have a clear idea how you can diversify your FD amount. Not only that, it is not related to market link, it is not related to bonus of the company. So you will sure that what is the money you are going to get. Next, of course, it is not beating the inflation, because overall if you calculate the IRR, you will get hardly 6 to 7% return. But when you reinvest this money, whatever the returns which you are getting, when you reinvest that money for next 10 or 20 years in SIP or like mutual fund, lump sum money, then only you can get a good returns which can beat your inflation. Now, when it comes to our next question, is it sufficient for my retirement? Definitely not, because this is not the only one solution which you are getting. This is an alternative option for your FD, where you can get some advantages more than the FDs. Now, when it comes to the retirement tool, there are a lot of other options also available, and you should have a diversification in your portfolio. So under this diversification, this can be one option. Now, when it comes to the next part, who can take this? Definitely you may have this question, right? Is it suitable for everyone? Of course not. Now, a person who may be at the age of 30 to 50 and who is having a very good income and who is looking for steady income and who is capable enough to pay our next 10 to 12 years of premium, then they can opt for it as one option for your retirement tool. And the important thing, you should have a other plan for your other goals, like maybe children's education or children's like post graduation or graduation, or maybe you may be having some other goals. For that, you should have a proper plan. You should have done your financial plan so far. Next important thing is a retired people who have already retired and who is having a huge corpus for their retirement, even for next 30 to 40 years. If they live husband and wife, then they have a sufficient money for their corpus for their entire retirement, but they have a excess money or excess corpus where they wanted to transfer their legacy to the next generation, maybe for your children or grandchildren, and you have a plan that okay, they should get consistent income every year. Then this may be one of the solution where you can think, okay, there is a consistent income and this income is going through. You can be a proposer and they can be a life insured there. Next, the very important aspect is those who are having a family business or having a big business where you are getting good profits and you have to pay big chunk of money for the taxation on your profit. Then if you wanted to transfer a legacy to the next generation and you are all the family members who are included in your business, then you can take this as a employer-employee insurance where you are paying a premium of this insurance and you can show as a employee expenses under section 37(1). If you want to know more about that, you can contact us and we will help you to figure it out and help you to generate more income as well as reduce the taxes through these plans. Now, this video is only for educational purposes. This is not a financial advice. Please consult your certified financial advisors and may prepare a plan and then plan your investment. If you are not getting anyone and if you want to get a service from our company, then you can contact us. The link is given for a one-to-one clarity call in the description. Please go on there, check it out and then book a clarity call and we will help you to figure it out, your investment, your expenses, your financial goals, and we will help you to plan your finances in a right way. Now, if you have not yet subscribed this channel, please do subscribe because in future we are coming up with a very interesting topics like power of compounding, SIP, SWP and many more. And if you think this is very useful for your own family members and friends who have kept huge money only in EFDs and they are looking for a diversification, then please do send this video to them. Thank you so much. I'll see you soon in next video.